his left is Doug Jamieson, who is the Chairman and Chief Executive Officer and Managing Director of Harris & Harris Group, a publicly traded venture company listed on the NASDAQ Global Market. They leverage their core scientific expertise to identify new technology trends in accessing high-quality science and intellectual property, in building management teams, and in executing on early-stage business growth. Biology Plus is Harris & Harris's distinctive approach, and they define Biology Plus as investments in interdisciplinary life sciences companies where biology innovation is intersecting with innovations in areas such as electronics, physics, material science, chemistry, information technology, engineering, and mathematics. To his left is Edmundo Gonzalez, operating partner at Columbus Nova Technology Partners. Edmundo has over 15 years of experience in venture capital, where he has executed dozens of transactions, including principal investments, mergers, acquisitions, sales, and recapitalizations. Columbus Nova is a global multi-stage technology investment firm that prides itself on playing the long game and prioritizes long-term relationships over those with odds for a quick exit. Edmundo works on all aspects of the firm's activities, including structuring deals, due diligence, and working with management teams to achieve their goals. To his left is Max Chi, a partner at Millennium Technology Ventures. Max joined Millennium in 2005 and has more than 15 years of experience as a private equity and venture capital investor. Millennium is a venture firm with a later stage technology company focus, but has been a pioneer in designing and providing alternative liquidity solutions to shareholders of venture-backed companies. And last but not least is, Greg Bolin, the managing partner of Union Grove Venture Partners, which he founded in 2014. Greg's experience and relationships in the venture capital investment banking communities has been developed over the past 30 years, and he has invested in over 50 venture-backed companies. Union Grove seeks to invest in top-tier, access-constrained venture funds and strives to be a value-add, limited partner in a true partnership model. In addition, Union Grove makes expansion and later-stage investments in companies with high-quality management teams and differentiated products in growing markets. They often lead and price the majority of their direct investments. Okay, so thank you, panel. Our own version of the Shark Tank, and they're ready to lift up the curtain and teach you how to avoid many of the traps for the unwary. So for the first topic, just want to discuss timing. Now, when is the right time for an early stage company, particularly the one seeking its first investment from an institutional investor? When is the right time to seek a term sheet? What metrics do investors look at? So, Edmundo, I'd like you to provide some insight from the technology perspective, and then Doug, perhaps you can address this on the life sciences side.
I'll go first here. I think that, I was taken by what Uri said over the keynote. The right time is really varied, obviously, by company. If you can create some kind of competition, in other words, you're talking to various investors, that is when power shifts a bit from this side of the table to you. That's simple negotiation. But it really varies by fund, right? So I don't mean to evade the question, but some of my colleagues here will invest in assets that I wouldn't even look at because I think they're too early stage. So I would say do your work in terms of who you're talking to and what stage they invest in to really match where you are.
Yeah, I guess the real question is, when is the right time to raise money? Having spent years in the business, I'd say raise it when you can, when the ducks quack, feed them, and raise a lot of it, because it takes a tremendous amount, especially in the life sciences, but in any of the hard science areas. Again, maybe two perspectives. One, we tend to be very early stage, so we tend to actually spend more time looking. We sort of are thesis driven, so we spend time understanding an area, microbiome research. Right? Understand how we think we can play that. Who are the corporate people in this space? Who are the academics? What other venture-backed firms or startup companies are in that space, we tend to look like that. So we tend to go out very early. And it's not really a term sheet discussion you're having. It's really we identify somebody, we start talking to them, and most of the time we end up doing a convertible note into the company, right? So the idea is you push back all of the difficult conversations. You push them back a little bit because you're talking about $200,000, right? $300,000, $400,000, $500,000, sort of proof of principle. What experiments do you need to really get it to a term sheet, Series A, seed stage equity deal? So part of the answer is, when you're dealing with very early stage investors, I think most of them are comfortable with convertible note type operations. You don't spend a lot of legal money. You get into using that money to run the experiments you need to see if this has legs and it can go out and be presented to another group. I think that, I think that other than that, on the term sheet, it depends what you're doing, right? Again, if it's a big idea, early concept, you can sometimes raise money on the term sheet very, very early. If it's a life science platform company, and you want to see, you might want to go look at SBIR funding, some validation, some credibility, before you go looking for the term sheet, because chances are the investors are going to want to see some sort of credibility or validation of that technology ahead of time. So I agree. I mean, it depends on where you are, what the technology is, but to me, it's convertible note in the very early stages if you're dealing with a very, very early stage investor. And then it's, is it a big idea that's going to be able to interest a lot of different groups? And then you can go for a term sheet early. And if not, you probably need some sort of credibility validation. You can take it and say, look, we've run these experiments. The government gave us money. I have some angel dollars in the deal or something like that, a convertible note. And now we're ready for, $2 million, $3 million, $5 million.
That's great. So if a company's received a convertible note and it's kind of ready now to raise a larger amount of financing and it's now talking about a priced equity round, how much due diligence is done, by the investors before the term sheet is actually even given? Understanding that after the term sheet is drafted, there's a period of negotiation of documentation and more diligence that's done. But Brad, is typically there a significant amount of diligence that's done before a term sheet is issued, and can you speak on what's typically done?
Sure. Again, it really depends upon the stage that we're talking about. We sometimes actually create companies with the entrepreneur, so that's very, very early stage. And in that case, these are entrepreneurs we've worked with before, and we're really kind of betting on the guy, and there really isn't that much due diligence. But if we're investing in a technology company, especially if it's a new type of technology, the likes of which the world has never seen before, we'll want to do a lot of due diligence. I'd say the guiding principle is you really don't want to have to pull a term sheet. I think only once in my career have I ever pulled the term sheet. So by the time you actually hand that entrepreneur the term sheet, you want to be damn sure that you intend to go through with it and execute that transaction, and that you're comfortable with the investment.
And Max, on the life sciences side, is it a similar approach? Is there a lot of diligence that's done prior to a term sheet being issued?
I'm on the IT side, so.
Okay. Any of our life sciences panelists who can maybe speak to that question?
Sorry, I think there are two of us on here, so I'll take that one. So I should first preface with my context that my answers are from the perspective of a strategic venture capitalist. So we invest on behalf of AbbVie, and so when we do diligence, it's a little bit different, I think, than the traditional folks when they do diligence, because we have an army of folks to consider, right? If we have a question, there's someone in-house who probably knows. We have, just by way of context, so people know, because talking with some folks out there, not everyone is familiar with AbbVie. 28,000 employees, $20 billion in revenue, large pharmaceutical company. So we approach these types of transactions very differently. So I guess I'll ask you to keep that in mind as I provide my insights here.
I will make a comment, though. I think for the entrepreneurs in the room, every VC has a different style, a different process around when they want to issue that term sheet. So I think it's fair game for you to ask, what is your process? When do you issue term sheets? Do you pull term sheets ever? How committed are you? I think it's fair game because every VC has a different style, a different approach. and you really want to understand what it means to get that term sheet, how long will it take, and get them to some sort of sense of timing as well, so that you know that they're not wasting your time, and that you understand how they make decisions as well. So just like any good salesperson would try to figure that out if you're trying to close a deal, that's sort of what you're trying to do. So that's the feedback I'd give.
Okay, Greg, we talked about the investor doing diligence on the company. How about an entrepreneur doing diligence on the investor? We talked about in the earlier panel about checking the website, seeing the other portfolio companies that investor is invested in. But there are other ways that an entrepreneur can learn about working with a fund or a particular partner at that fund who may be kind of the champion inside the fund for the investment.
Yeah, I think as entrepreneurs, one of the things that you guys should do is ask us for references. And so the first thing you should do is actually find out who the partner is going to be that will be assigned to your company. If it's a board seat, then that's different than observer rights, which is different than a passive investment. But if the person that is going to be assigned is going to be on the board, then you should absolutely call companies where that investor has been on the board before. And do the same thing that we do, which is, look at his failed companies, look at his successful companies, look at the companies that he's currently invested in, and make at least 6 phone calls to try and find out what the behavior has been. And remember, you probably learn a lot more from a failed company and the behavior of the investor in a failed company than you do from the successful ones.
Great, thank you. Okay, so the prior panel discussed how to make a compelling pitch to a VC and get to the stage where a term sheet is ready to be offered. Should the entrepreneur take it upon himself or herself to draft the term sheet and share it with the investor? Does anyone think that that's a good idea, or should they wait for the investor to deliver that first term sheet? Alex, maybe you'd like to opine on that one?
Yeah, so I think if you're dealing with institutional investors, it's never a good idea. The NVCA, for example, has a great sort of very vanilla template term sheet. You can use that if you want as a starting basis. If you're dealing with more angel investors, I think it can be a good idea. And maybe you still use the same NVCA thing, but you can maybe tailor and be a little more specific to your company. The other time when it can be sort of a good idea is not for you to sort of draft it yourself as the entrepreneur, but if you have a little bit of money coming in already, even if it's friends and family, you can sort of work with them to draft the right term sheet and use that as a template to try and get bigger investors to glom onto it.
Anyone else? Maybe like a comment too. I don't know if you want me to take the question here, but I don't necessarily think the term sheet's the right stage to think about here. I think it's more around the collaboration agreement. Before you get to that term sheet stage, right? You have to think about what that collaboration looks like, and there are drafts that go back and forth before you actually put pen to paper and draw out the term sheet. So I guess if I were in your shoes, I would start to anchor the way that any good negotiator would begin by speaking about the structure, putting sentences together, and because that's what will eventuate into the term sheet. I think that the drafting of the term sheet, you're right, I think from at least a farm perspective, institutional perspective, we have language that we like to put in there, and we typically will, but the dialogue starts well in advance of that, so that's something to keep in mind.
I could just add something. I think also you should see the term sheet as it's an event, but it's not necessarily an end game, right? The conversations and the structuring of this happen not because we give you a piece of paper that may be 2 pages or 10 pages, but regardless of that, it's really that conversation that led to that, and that impacts valuation, the structure. I'll just give you some examples. We have a phenomenal company in Silicon Valley where the entrepreneur still holds 70% of the company. $8-9 million has gone in. Platinum investors, Bain, others in there. And he has essentially set the rules. So when I started talking about power, shifting from this side of the table to the other, it really is about, who you are, right? There's entrepreneurs right now in the Valley being funded to the tune of, $40, $50 million with zero revenue based on a business plan because they happen to have sold their company for $500 million, 3 years ago. And I'm guilty. I'm happy to write those checks because I'm betting on a person, right? But understanding that dynamic, I think, will allow you to then make the final ask. We wouldn't have more than one term sheet outstanding in our small fund. We're only a $250 million fund at a time. So when we have the term sheet out, we're going to close. This is almost the end stage, and you should know that on your side too. We're not just throwing out term sheets to everyone that shows up. Sorry for the long answer.
No problem. So you mentioned the magic word, and I think it's always on the mind of an entrepreneur, and that's valuation. So when is the right time to start that discussion on valuation with an investor? Is it at the first meeting? How do you kind of signal as an entrepreneur kind of where you want to go? And what are the other factors which I think many entrepreneurs don't fully understand when they just see kind of that headline pre-money valuation that really impact what the valuation is. So maybe Brad, you can talk about when the right time is and some of the other factors that go into the calculation.
Sure. We have a very mathematical approach to valuation and term sheets, probably just because I have an applied mathematics background and do a lot of structured finance. So I'll start by saying when the wrong time is, and that's early on. Generally, the valuation you want to be the very last item that you want to put on the term sheet because there are so many things that lead into the valuation. I always tell my entrepreneurs, no, I'll give them whatever valuation they want if I can set the other terms. Because the terms such as whether you have participation or not, whether you have preference multiples, how big the option pool is, what the anti-dilution looks like, if there's redemption. I can talk for days on different terms you can put in there. But generally what you want to do is you want to nail down all the other terms so you really know what you're dealing with because the valuation is really just one variable. I'd also, on a related topic, I would warn entrepreneurs not to look for too high of a valuation because that can also kill you. I've seen valuation frenzies where the entrepreneur is fixated on a high valuation because his friend got a high valuation and he thinks it's indicative of the value of his company. Nothing kills a company faster than having too high of a valuation early on because this is a multi-step game. Generally, before you actually achieve liquidity, you'll have 3 or 4 rounds of fundraising. And if your valuation is too high, and God forbid you don't make your plan, which you won't, and you have to raise subsequent rounds at a valuation lower than your prior valuation, that will hurt you so badly that it will take 2 or 3 more rounds to get back to where you would have been had you just started very low and had a nice upward trajectory.
Any other thoughts on valuation, Alex?
Actually, I totally agree with Brad. It's shocking how fungible valuation is. You think the price per share is important, but it's only one thing of many. And I also agree on holding it as late as possible in the conversation. It's funny because most of us are at times on both sides of the table, right? Because we're negotiating term sheets, but then our portfolio companies for the next round are the ones doing it. So when I'm the new investor, I always ask right away. At the end of the first meeting, I'm like, hey, in an innocuous way, what are you guys thinking about valuation? And see, what they say, right? It might be really high, it might be reasonable, and it just sort of gets me going. But when my CEOs are out there doing it, I always say, if anyone asks you that, you say, we're going to get a market deal. We're talking to a ton of people. I'm confident we're going to get a market deal, whatever that is. And that sort of lets them know right away, hey, you're talking to other people, you might be reasonable, you might get a market deal, whatever that is, and it sort of keeps the venture guys honest, I think.
So basically, if someone asks you, don't tell them.
So I think that, I think the thing that an entrepreneur can do, though, is you can figure out who you're talking to, right? So to me, again, venture capital is in the pot of capital available is a tiny percentage of all capital raised, right? So there are plenty of sources of capital for entrepreneurial firms. And if you look at great entrepreneurial firms, some are not venture-backed at all, right? Some are angels, some are family money, some are private equity coming in much earlier than you would ever expect private equity to come in. So I think the question you want to find out is you want to see what type of ownership the investor sitting on the other side of the table expects. And I think that's not a conversation. I think that that's your diligence homework to figure out. Because if you're talking to someone that needs to own, an early stage investor that's going to want to own, 20, 30% of the company, or the first syndicate always owns 50 to 60% of it, and you're not in that ballpark, you're not going to move them much off of that, right? I mean, that's a learned exercise that they've done, understanding dilution they face later in the game. So, you need to understand that and who you're talking to. Because if you go, I'm an early stage firm and I believe my technology is worth $1 billion and I'm going to sell you 2% of the company for $1 million, you're not even in the ballpark, right? So you should know that going in. I agree, it's probably not a conversation, it's you doing the homework to figure out who your investors are in that game. And again, I would definitely reiterate, in the hard sciences, it's a long, long game, and I think this question that comes up later, but it's so much harder to take a step down than it is to move incrementally up. And you risk it. You never have to raise capital again, all power to you. But if you're going to have to go back to the well, I think that I see more private venture-backed companies there's not a market clearing price, the deals just die because of that.
Yeah, I would just add that you may not want to disclose what valuation you want to get, but you want to be thoughtful about it. And you want to say, look, company X, Y, and Z at this stage got this valuation. These guys got this valuation. And the most powerful thing is if you do have more than one investor interested, get them to make you an offer, and then you can use that as your anchor on pricing. So, valuation is the most. It's such an art in this game. The discovery is the real key here. Is if you can get 1 or 2 people to be interested, if you get 3 people interested to give you an offer, you pretty much have the market there to decide whether or not you want. That's pretty much going to be your valuation if you have 3 people to bid on you. Then it becomes all the other intangibles and all the other terms. And I think I agree. If you go to the nvca.org website, look under resources, look under model term sheet. Those terms haven't changed in the 10 years I've been doing this. It's very standard, and it's a good way for you to sort of match up what's sort of quote unquote market that's out there. But from a valuation standpoint, you do want to be thoughtful. You do want to sort of anchor yourself to as high as possible. But at the end of the day, it's all about who's really interested in your company, and then getting that sort of auction process going.
And Greg, does someone have something to add? I'm sorry. Okay, sure.
Just to follow my colleague's thought, I just want to maybe say something a little bit provocative. Valuation is not a number, and it's kind of, you say that and you're scratching your head, what do you mean by that? Well, normally in these deals, of course there's a headline number, 70 million, whatever it is, but the structure of the instrument is so vitally important that for people on this side of the table, it can make that number irrelevant. If it's a participating preferred, if you have a 3-time liquidation preference, okay, so fine, I'll give you a $100 million valuation because I know that I'm going to still make a return, which is, someone has to pay for that return, right? If I'm making a bigger return, it means the other investors are not. So my biggest advice, and I tell that I'm invited to Columbia Business School to their entrepreneurial program every year. I always tell them that the best advice, hire the best lawyer, because you can bet that everyone on this side of the table has them. So.
Goodwin Procter agrees with that advice. So just I do want to move on, but how can an entrepreneur understand if he has any leverage at all when negotiating? So you get a term sheet, it seems okay, you'd like to push back, but you don't know if that's going to cause the investor to walk. You may not have a bunch of other investors, lining up to invest. Could be the only game in town. I mean, how do you know how hard to push? Are there ways that you can, gauge what that leverage is without being too overt about it, perhaps?
Well, remember, I have the dual joy of negotiating term sheets with venture funds, because I invest in venture funds. And the thing that we always look for are what we call walk-away points. And there are things inside of term. I mean, the term sheet can be as complex as it needs to be and as simple as it needs to be. And the term sheet can have things as that I've seen as bizarre as they get to bring their dog to work. And I've also seen them as simple as here's the price, here are your rights, sign. But the walk-away points with the VC, and you know, you can see a lot of those terms that the VCs have negotiated before if they have had companies that have gone public, because you can backfile against the S1s and the classes of stock. And so you have a guide if you are willing to do the research as to what VC firms have done in the past and are willing to do for their investments. And you can learn if you aggregate, and we always talk about aggregating against the mean. You know, if you have 10 term sheets, you line them up and they all have these points, you know that these points, whatever number there are important to the VC firm. You're not likely to win on those unless you have, you know, built Google before and are now going to build a data processing, big data processing company, and you know everybody knows that you've got the horsepower to do it, and you know you're just the hottest thing in Silicon Valley. Probably not very many people in that category, and so learn the walk-away points first, and then try and negotiate the things around the edge that are to your advantage.
Great. So I want to move off valuation and talk about some other key